Hi folks, Happy New Year and welcome to the Meaningful Money Podcast. This is Season 18, Episode 8. This is the podcast dedicated to helping you put your finances in order in 2021. My name is Pete Matthew and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Yes, indeed. HNY to you all. Hope you're doing really well. Hope you had a decent Christmas break. For those of you for whom it was a break, for those of you who were working, thank you very much for your service, and hope you were able to have a good season, shall we say. So let's just hope that this new year will be comprehensively better than 2020, huh? Okay. So I am now returning to the ultimate guide season, dealing with the thorny subject of investing in retirement. And this is timely because today, when this goes live, Wednesday the 6th of January, it's also the day that we are launching the retirement planning phase of Meaningful Academy to founder members. So much more on that after the main content, after which obviously I'll look at the most recent review that's been left, announce what we're going to be talking about next week, all that good stuff. But before any of that, remember, as ever, this podcast continues to be brought to you with the help of my friends of 7 Investment Management, closing in on 10 years now that they've been helping me, spring of 2011. So super grateful to them for that. Please do check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. Go check them out. Now, investing in retirement is a subject of lots of scholarly research, strong opinions, and in my not so humble opinion, there's a whole boatload of crap information on this subject. My job today is to try and cut through all of that and give you the stuff that you really need to know and do, of course, to invest successfully in retirement so that you don't have to wade through all that stuff. If you don't want to, that is. You can if you want to. Many of you I know are sort of big into this stuff, but it won't surprise you to know that I'll obviously go deeper into this subject in Phase 3 of Meaningful Academy, more of which later, but I hope to give you enough today to give you a really good grounding in the subject of investing in retirement. So remember, notes and links from the show notes, from today's show rather, they are at the show notes, which is the only link you need to remember as you're listening to this, meaningfulmoney.tv/UG8. That's for Ultimate Guide number 8. meaningfulmoney.tv/UG8. Let's look at everything you need to know first. Okay. Inflation is the silent killer. Number 1. So important that everyone planning to retire or achieve FI, however you want to put it, so important that you understand just what a massive deal inflation is in retirement. We spend most of our time not worrying too much about inflation too much as we're working, particularly for a couple of main reasons. Firstly, wages generally increase ahead of inflation, so we earn a little bit more in real terms each year. And yes, I know millions of public sector workers are cursing me now. I know, by and large, you haven't had super inflationary pay rises for a long time. I agree that it's wrong, but let's stay focused on the point here. If inflation is at, say, 2%, meaning that everything gets 2% more expensive this year compared to last year, but if you get a 3% pay rise, then you're 1% better off, are you not? So this means that for most of us, while we're working, we don't pay much mind to inflation because we're beating it, essentially. But that is very often not the case when we're retired. More on that in a sec. Secondly, the stuff we tend to buy more of when we're retired is often itself super inflationary. So food and fuel generally are the main budget lines for many retirees. I know that's a huge generalization. Not everything goes up by a uniform rate of inflation, of course. Some things get cheaper, some things get more expensive. When we talk about inflation, we're averaging by definition, and the government uses a standard, quotes, basket of consumer items and services to find that average. Also, we're all different, right? You might buy more stuff that goes up in price than I might, or vice versa. So we each have a personal rate of inflation, which, you know, if we didn't have a life with real people and interest in it, we could probably spend some time working that out. But most of us, when we retire, we have one main source of pension income, which is indexed and which rises over time in a bid to keep pace with inflation, and that is the state pension, of course. And for many of us, it will form the bedrock of our retirement income, which is good. It does rise a little bit. But for most of us, And for an increasing number of us in the future, we just won't have any indexed sources of income, rising sources of income after that. Defined benefit schemes, pension schemes, that is, they're called the gold standard. Did I say cold? They are called the gold standard for this reason, really, among many others. Income benefits from defined benefit pensions are indexed. They rise each year. Whereas if instead we've got a collection of defined contribution pensions pulled together throughout our working life, and so we now have a pot of money, and that's got to last us the rest of our lives, right? That's most of our situation. And for many of us, the rest of our lives will be a long time. So I put a link in the show notes to the ONS longevity calculator. Try this for yourself. It's good fun. I put in that I was 60 years old. I'm not. I'm 45 and looking well on it. I'm sure you agree. But a 60-year-old bloke like me has an average life expectancy of 85, right? Average. So half of all 60-year-old me's will live beyond age 85. There's a 1 in 4 chance that I'll live to 92 and a 1 in 10 chance that I'll get to 97. So let's take the average, though, and let's just say I drop dead when I'm 85, exactly 25 years after I plan to retire at age 60. So let's say I want to spend £40,000 a year in retirement, rising by 3% inflation for every year that I'm retired. Well, in my last year of retirement, the year before I die at age 85, my lifestyle will actually cost £84,500, more than twice what it started at. If I live for 30 years, that figure will be about £113,500. Nearly 3 times the annual, the original annual amount. I think that's 35 years, actually. I think there might be a little typo in my script there. But either way, it starts at 40,000 a year, and it gets to a lot more than that. So if I have just a small portion of my expenditure needs covered by my state pension, and the rest of my life has got to be funded by a finite pot of money, I really, really do need to invest wisely. So let's not mince words here. The risk of running out of money in later life is way bigger. Much bigger risk than like your Tesla shares tanking or losing some money on Bitcoin, because inflation is pretty much a given. It's not a risk, it's a certainty to all intents and purposes. And so we've got to give ourselves the best chance we can of beating it. So let's not beat around the bush. Inflation is a big deal, particularly in retirement. Second thing we need to know is that investing in retirement is more about organising than investing. I mean, investing really isn't rocket science, is it? Despite many of my own profession thinking that they've got some kind of magic secret sauce that only financial advisors can understand and that lay people will never grasp. And that's why you need to pay financial advisors too much money to invest your money for you. There's definitely a soapbox video in here, isn't there? I'll just need to make. If I do make it, I'll just have to reconcile myself to being a pariah amongst my peers afterwards. But anyway, what is investing, really? It's buying and holding growth assets for a long period. It's controlling costs, including tax, because costs compound negatively, affecting your returns significantly over time. And that's about it, isn't it? Really? Plenty of people will try to put more on it than that, but if the most successful investor of all time, Warren Buffett, thinks that most people just need to buy index trackers, then it's good enough for me. Now, I did a 2-part ultimate guide to investing earlier in this series, so I'll link to that in the notes. So there's no really need to go over that ground again, but my contention is that investing in retirement differs from investing in the accumulation stage primarily in the arena of organization rather than the basic mechanics of making money. Different assets, things that you can buy to make money, different assets behave differently. Some are clearly growth assets, some are more income-focused, some are a good blend of the two, some are designed to minimize volatility, and those might serve us pretty well in retirement too. Different wrappers have different tax benefits, and so they can serve different purposes at different times. Giving our money the best chance of surviving a long retirement, then, is about making sure we take money from the right assets, from the right wrappers at the right time. And that last point is the most important of all, at the right time. Timing is very important in retirement. I don't mean timing the market, which is always impossible, but the timing of withdrawals and the choices of place that we take the money we need out of our portfolio. These are huge determinants of our success or otherwise. So not only do we need to understand this, we've got to build a framework for our investments that make this stuff as easy as possible to administer on an ongoing basis. Okay, number 3. Before we get more practical, I want to address what I'm going to call the law of diminishing returns, and I see this manifested all the time. I tend to attract people to this podcast who are very bright, perfectly capable of running their own portfolios and finances. I absolutely love that about my community. It makes for some challenging conversations, I can tell you. But these people very often are actually interested in investing. It's a hobby for them very often, and like any interest, it can easily become all-consuming. So we take in more and more information about it. We seek to learn as much as we can. And while that's a good idea in principle, in practice, I see that lead to two very clear and potentially dangerous outcomes. First, we can begin to obsess over details, which, when we apply those details, can actually make very little practical difference. And yet they take on a weight in our thinking, which is far more than they should have. So I've had conversations with listeners obsessing about single-figure percentage differences in their allocations to the UK market versus, say, the US. Or even going deeper still, lying awake at night worrying whether their allocation to emerging market debt is too high at 4%. I remain convinced that unlike, say, golf, right, where hours on the driving range and the course presumably lead to more consistent and predictable results, the markets promise no such thing. Ultimately, there is no right or perfect or correct asset allocation. Endless worrying and tweaking is unhealthy and will actually achieve very little. The second outcome is that too much obsessing over minutiae, trend line interpretation, general sort of financial navel-gazing, more often than not leads to inertia. So people are constantly looking for just that little bit more information before they actually take the plunge, that little bit of clarity that they feel is lacking before they go ahead and commit. And they never find it. I met one lady on a Zoom call whose office behind her was absolutely full of investing books, all of which she purported to have read. And yet she was, by her own admission, too afraid to invest, which is why she contacted me. Investing actually remains very simple for most of us, so please don't try to overcomplicate it. You'll do so to your own detriment in the vast majority of cases. Okay, preachy bit over. We know inflation is a big deal. It's a huge deal, in fact. We know that investing success in retirement is more about organising withdrawals and tax wrappers than it is about the investing itself. I've warned against the dangers of overcomplicating things. And really, if it's as simple as all that, what should we actually be doing to set up our money effectively in retirement? Let's have a look at everything you need to do. Okay, number 1, don't de-risk your portfolio prior to retirement. So it's actually a don't, not a do. Don't slavishly de-risk your investments and pensions in the run into retirement. I hear it all the time from prospective clients on email, on initial calls, words to the effect of, well, I've started to move more money into gilts as I get closer to the big day because that's the right thing to do, isn't it? Well, it might be. And as ever, the key word here is to be intentional. So we're going to talk shortly about cash flow needs and timelines, and this will inform our need to de-risk or otherwise. But please don't just do it as a matter of course. If you're in a so-called lifestyling fund in your pension, which automatically move money into lower risk assets in the 10 years prior to retirement, you need to seriously consider switching out of those in case you do irreparable damage to your chances of making your money last. The reason those are set up is because most people used to buy an annuity at retirement, which was a cash event. You would hand over your money in return for a guaranteed income for life. Most people don't do that now. You may still need to do some de-risking, but not wholesale. And we're going to get into that shortly. So don't de-risk your portfolio. The first thing you need to don't. Number 2, first thing you need to do really is to establish your cash flow needs. And retirement really is all about cash flow. All right, it's funny that, because so is the accumulation phase. So if you were to ask me to distill personal finance and how it works to a single sentence or principle, really it's about managing money in and money out, right? And that's true when you're saving up for your future, managing a mortgage, or drawing down off your SIP. Cash flow really is king. Good cash flow management is so far above every other aspect of financial planning. It makes things like asset allocation and fund choice really look pretty insignificant in comparison. So when I'm planning with clients coming up to retirement, I spend time trying to help them establish their cash flow needs for the first 5 years of retirement, because that informs just about every other decision when it comes to their finances, from how they should invest to whether they should take their tax-free cash from their pensions, lots more besides. So this is your first job. if you're heading towards retirement and you're looking to set up your finances accordingly, the first thing you need to do is to plan your spending. All right, this should be fun, right? Right? It's about spending. It's about enjoying money. So start with your basic monthly expenditure. What does it cost to run the household, to eat, to run 1 or 2 cars, to pay for birthdays and Christmas? No frills, just the basics of living. What does that cost? Write it down. Next, what about leisure and luxury? Right? These are the costs of things like club memberships, Netflix, regular holidays. Write those down too. Those 2 categories added together give us our desired lifestyle costs. It's a brilliant start, right? That's our sort of baseline, what we would like our lifestyle to cost in retirement. But too often people forget to factor in milestone costs. And this is things like changing the car every X number of years, taking that big family holiday when you retire with the whole family to a gîte in France or to Center Parcs or whatever. Perhaps you've got a family wedding coming up, or your daughter wants to take a master's degree and you want to help her. Feeling my little pain there. Basic, leisure, luxury, and milestone costs, right? You're going to need to know what these will be for the first 5 years of your retirement. And don't forget to include inflation. Your basic and your regular costs, your basic and your leisure luxury costs will need to increase each year by inflation. And if you know what your ideal new car costs now, but you're not going to buy it until 5 years' time, then you'll need to factor some inflation in that too. That done, you're going to need to understand your sources of income for the same period, that first 5 years. So that might be state pensions, depending on when you're retiring, DB pensions, rent from investment properties, or whatever. You'll know what they are and when they'll come in. Only factor in known sources of income, not possible ones, like inheritances. Don't forget to factor in tax. If any of your income sources are not taxed at source, or if you tend to get statements and they talk in gross terms, make sure you factor in tax, really important. Obviously, it's an expense that you're going to need to factor in. So if we know what's going out and what's coming in, we can work out the gap between the two, and that is our cash flow need for the first 5 years of our retirement. Err on the high side. Take it from me. Generally, clients spend more than they think when they retire, at least at first. It takes time for things to settle down to a new routine. Combination of more free time, good health, hopefully, decent investment balance makes for a pretty heady mix. So maybe factor in 20% contingency, perhaps, to your cash flow needs in that first 5 years. Once we've established what cash flow we're going to need, then we can move on. So step 3 is to build a cash flow ladder. Cash flow ladder really is simply about having the right money available at the right time to spend. It's also about protecting the money that you're due to spend in the short term from unhelpful market movements. So I've produced a sort of outline diagram of what a cash flow ladder looks like. You can download it from the show notes, meaningfulmoney.tv/UG8. But the basic premise is that you ladder your portfolio. Portfolio, you can read pension funds and ISAs, at least for most of us. But you ladder it based on the time scale in which you're going to access that money. So knowing what our cash flow needs are likely to be for the next 5 years means that we can keep this money in cash or very low volatility investments. Money which we know we're not going to need for, say, 6 years or more can be invested for growth, knowing that we can let any fluctuations ride out for a while yet. The rationale is that if you keep 2 years spending needs in cash, and actual cash, right? If you can do that, then you shouldn't need to access the invested part of your portfolio while it's sitting on a loss, because almost all market dips return to some kind of normality within 2 years. And particularly if you have a well-diversified portfolio across different geographies. Doesn't always work, right? It took some of the major stock markets nearly 6 years to recover their value, even with income reinvested after the great financial crisis. That was a singular event, mind, definite outlier, but that's not to say it can't or won't happen again. So for those of you who don't have the graphic in front of you, picture a ladder with 4 levels or a set of 4 boxes placed one on top of the other. Might be easier to imagine. At the bottom is the money you're going to use in the next 2 years, years 1 and 2. That should be kept in cash. No arguments here. There should be no risk attached to that money. You're going to spend it within 2 years. It should be risk-free. And for that, it needs to be in cash, in the Bank or Building Society, premium bonds, national savings, whatever. Don't worry about interest rate. This is not about earning money. It's about that money being there risk-free. Second box up, the second level on our ladder is for years 3 to 5, and that should be invested at a lower risk level than you might ordinarily be comfortable with. Might be that you'll need to spend some of this while it's still invested, right? If we get another financial crisis, we might need to dip into that, right? So it should have a larger than you might think element of bonds in it. Low volatility, investment grade, government bonds, ideally. Now, if you're a balanced investor by nature, let's say we might equate that to a 50-50 equity bond portfolio, you might want to dial your equity content in this years 3 to 5 box way down, maybe down to 30% with 70% in good investment grade bonds. Point is that you should have a good bond portion that you can access in a pinch, because it will generally be less vulnerable to market movements. Again, huge generalizations here. It's the nature of the beast, unfortunately. Ladder rung or box number 3 is your years 6 to 10 box. So you're not going to access that money for at least 5 years. And that means you can afford to invest it just as you would have done when you were accumulating. In other words, in line with your standard attitude to risk. And then finally, the top rung is money you're not going to need for at least 10 years. And that means you can really push that money hard to get the growth that you're going to need to beat inflation over the longer term. And essentially, that's it. That's the cash flow ladder. Except, of course, that it isn't. What about the split between pension and ISA, for example? Well, it's easy to overthink this, but if I were planning for you, I'd be telling you not to try and predict where you're going to need to take the money from for every year throughout retirement. There's just too many variables over such a long period of time. But instead, if you look ahead just 5 years, if you see that you're not likely, for example, to have any earned income in 1, 2, or 3, or all of those years, then you're probably going to want to consider using a pension withdrawal to use up your personal allowance, perhaps. So you're going to need to make sure some of the money in your pension is positioned correctly on the ladder so that you can draw it down at that right time. And that might mean some money sitting cash or near cash inside your pension for longer than you might sort of feel is sensible. Also, remember, everybody's risk capacity is different. Everyone's capacity for weathering market dips is different. The ladder is a framework to help you not have to worry about all that too much, but it is still a factor. Our behavior is still a factor, and we'll get to that shortly. One thing is for sure, though, number 4, you're going to need to get comfortable with risk. Now, chances are, if you've amassed decent pension provision over the years to get to the point of having assets to draw from in retirement, then you understand risk is part and parcel of building wealth. I've done tons of episodes on risk, most recently the last one in this series, so I'll link to that in the show notes. And risk is obviously a big subject, and that's why I dedicated an ultimate guide to it. But if you're a nervous investor, you're going to need to take 2 actions. The first is to educate yourself. Lots of unease around things like market movements is born of ignorance, or to put it a bit more kindly, a lack of understanding. That's not to say you'll ever totally understand how markets work or anything like that, but if you've spent time learning about how markets work historically, how the different asset classes behave, then you're unlikely to be too surprised, and that's half the battle. Secondly, you're going to need to jump in and get wet, because nothing beats practical experience. If you haven't already, read The Simple Path to Wealth by J.L. Collins. I did a review of the book, also interviewed Jim himself, which is a real highlight for me over the past 10 years of Meaningful Money. I'll put links to both the book and those episodes in the show notes, meaningfulmoney.tv/UG8. Now, if you start your education with The Simple Path to Wealth and keep listening to this show, as well as others like Money to the Masses, Maven Money, you'll go a long way to giving yourself the grounding that you need to succeed. Number 5, learn to ignore the news. Gosh, this is so important. Crucial part of succeeding with investing, no matter what your stage of life, is to just ignore the news. Right? That's not to say you should be ignorant of what's going on around you and what's going on in the world, but it's important to keep news in its place. Remember, the purpose of news is not to inform, it's to sell ad space and keep viewer numbers high. News is always biased, no matter where you get it from. For that reason, among many others, you should treat it with massive suspicion. And if nothing else, we've got to ask ourselves the question, when we see or hear something on the news, what difference does this make to my retirement investing timeline? Chances are it makes 0 difference, none at all. And if that's true, then why subject ourselves to information which actually has the potential to lead us into a second-guessing spiral, thinking about how we're investing. Potentially it might lead to anxiety and lost sleep. So just do yourself a favor and be really strict with your information diet when it comes to immediate term events, because with investing, it's the very long term that matters. Number 6, set your priorities. If retirement was only about making sure you have enough to spend on lifestyle costs, that'd be one thing. But there is more to life than that, and these more to life things will influence your investing approach and your timeline. So firstly, ask yourself, do you want to continue building wealth in retirement? Do you want to get richer? Do you want to do that for future generations or causes that you care about so you can pass on more when you're gone? Or do you want to spend down your wealth? Maybe you want giving to be part of your retirement spending approach, in which case you're going to need to factor that in, regular giving or milestone legacies. You're going to need to factor it into your cash flow planning. So your priorities for your retirement wealth will influence your investment plans too, of course, as the cash flow ladder might have larger amounts at the different levels, perhaps. Making significant capital outlays will also affect your choice of the source of that money, pension or ISA, for most of us. And that might change the dynamic of how your day-to-day income is sourced. So it adds a layer of complexity, but that's cool, right? I should say here really that this kind of bespoking is what the Voyant Go, which is the planning app that you get access to as part of your Meaningful Academy membership, it's what Voyant Go is made to do. You can go as granular as you like with that. That's basically how I spend my days earning my fees from clients, is sort of planning this stuff. So you can use Voyant Go to specify the source of money for a particular gift at a particular time. You can say which account it should come from, or which accounts provide your income, at which stage in life. It's just ludicrously powerful. And I walk you through how to use the app in one of the modules of Meaningful Academy Retirement Planning, one of those modules that will be available at launch as well. I should say will be available, is available at launch, which is today. So set your priorities for your retirement, because they'll affect your cash flow needs and your investing approach. Maybe I should have put this earlier in the list of points. Set your priorities. Number 7 is review, right? You need to review your investment portfolio, and it's about just a few steps, really. So firstly, review your cash flow needs for the next 5 years. Remember, you've used up one of your 5 years now. Let's say we're a year in, right? You've used up one of your 5 years that you planned for right at the start. So you need to add another one now to your next 5 years. Year 6 has become year 5, if you see what I mean. You also now have only 1 year of spending needs in cash because you've spent down your first 2 years cash buffer. So you ideally need to top that up. So that requires looking at the health of your portfolio. What are markets doing right now? How is the portfolio holding up? If you move money down from the years 3 to 5 pot into cash, where should it be taken from? It's not just a pot, it's got assets in it. Where should you take it from? If the portfolio as a whole is on a profit, that's great. You can shift some of the profit down to cash. If things are very bad, you can actually defer moving any money down the ladder to give things a chance to recover. Then you need to look at the balance of the whole ladder from the top section to the bottom, move money down accordingly if the time is right to do it. If not, then just defer it for a few months. Time is actually not that critical here. You should have enough in cash or very low volatility assets to live off for at least 2 or 3 more years if you need to. So there's no really need to panic, right? Wait until things look a bit more normal, shift things around then, or do it in stages. You are going to need to be fairly hands-on with this, but again, don't obsess about it. You've built time into the structure, so just chill out and take the time you need to review things. But set a date to review each year. Jim Collins, author of The Simple Path to Wealth, uses his wife's birthday as a reminder for him to do this each year. One of the modules in Meaningful Academy Retirement Planning is not available at launch, but will be available by the end of January, all being well, will be how to manage your portfolio in retirement, how to review your ladder so that you know what money to move down into cash and things like that. So loads of detail in there to come. Number 8, manage your behavior. I've done a whole season on behavioral finance, as well as various standalone episodes. I'll link to a couple of those in the notes. But behavioral finance, or behavioral economics, is the study of why and how we make financial decisions. Let me summarize it as follows, okay? Generally, we suck at making rational, logical decisions, thanks to our evolutionary history, the way our brains are wired. This is particularly true when it comes to money, because money is important. We know we need it to survive. We know we have a limited supply of it, particularly in retirement. So we tend to amplify our tendencies to make bad decisions around money. So we need to eliminate as many of those decisions as possible by building frameworks such as the cash flow ladder. Awareness is a large part of the cure. Well, never a cure. We can't be cured of our evolutionary biology. But being aware of our tendencies, both as a species and ourselves as individuals, will go some way to reducing the frequency and seriousness of our bad decisions. So listen to the past episodes, start to be aware. Dare I say it? Let's be intentional about the decisions we make as much as possible. Let's try to be mindful of our thought processes rather than just coasting through life as we might ordinarily do. All of our good work in planning our cash flow, building our ladder to fit, can be undone if we panic at the wrong moment. Potentially, we can do irreparable harm to our wealth in the process. Behaviour is important, and it's a life's work to understand. Finally, number 9, stay focused. Right? In a final sort of soapbox plea here, stay focused on the job at hand. While I always advocate simplicity and being as light touch as possible with our finances for the reason that I said at the beginning, it's not healthy to obsess. At the same time, you are going to need to be more hands-on with your finances in retirement, as there are more things to think about. Okay? So that's going to require continual laser focus. We cannot drop the ball. Our later years might be singularly crap if we do, and nobody wants that. Right? So keep the faith, continually readjust your ladder and your cash flow needs based on ever-changing circumstances and the unpredictable life events and all the confusing, challenging, exhilarating stuff that comes with being real human people. Right? Stay focused. So really investing in retirement, in summary now, isn't the difficult part. It's more about organising than some sort of magical investment methodology that's guaranteed to make everything just align perfectly. It's about planning and then staying nimble enough through regular reviews to adjust to changing circumstances. We really don't need to panic. We don't need to get anxious about it. If we're not retired yet, we just need to amass enough to be able to enjoy retirement no matter how long it ends up being. And that is the key word, enough. There's no point having too much. We really don't want to have too little. We just need enough. And then to put that money to the best use possible in the time that we're given. And that really is your ultimate guide to investing in retirement. I feel like I've just scratched the surface, actually. But that's what Meaningful Academy is for. And to coincide with the last few episodes in this season of Ultimate Guides, finally, we're launching the long-awaited third phase of Meaningful Academy, which is called Retirement Planning, to founder members. Founders get in early while the curriculum and the content is still being completed and refined, and they get a significant discount in return for providing feedback as the content develops. So the retirement planning phase covers investing in retirement in much more detail than I've been able to go into today, plus how to plan and execute your retirement plans effectively using the amazing Voyant Go financial planning software. 2 of the 7 modules are live at launch. There's another one due, as I mentioned, before the end of January, and just putting the finishing touches on it all. So this is an opportunity to get lifetime membership to phase 3 at the lowest price that it'll ever be. So to find out more, go to meaningfulacademy.com/RPFounder. That's for retirement planning founder. meaningfulacademy.com/RPFounder. Don't delay though. We close the doors to founder members 10 p.m. Friday, the 22nd of January. All right? That link again, meaningfulacademy.com/RPFounder. I'll see you on the inside. Okay, review from Chris Lapwing, who says, thanks. Love that. Found your podcast a month ago. A newbie. Great to have you with us. And I'm enjoying working through the back catalogue. Great, helpful indexing for those picking you up 10 years late. Thanks, Chris Lapwing. Really appreciate you jumping on board. I'm glad you're enjoying it. If you're enjoying the content, please do consider leaving me a review. meaningfulmoney.tv/love. Right, is the place to go to do that. meaningfulmoney.tv/love. Keeps me near the top of the rankings, helps more people to hear about the show and to subscribe. Okay, next time we're going to be talking about the ultimate guide to pension retirement options. So builds on today's show, really. Lots to deal with when it comes to taking money out of your pension accounts. Loads of options for life. Lots to cover there. So that's it for this podcast session, though. I hope you enjoyed it. I hope it was helpful. Questions or comments, or the transcript, all at the show notes, meaningfulmoney.tv/UG8 for ultimate guide number 8, meaningfulmoney.tv/UG8. Hope you enjoyed it, folks. Thank you so much for listening, and I'll talk to you next time.